Okay, let's unpack this. We are diving deep today into a story that, well, it completely rewrites the playbook for a major industrial giant.
HD Hyundai Heavy Industries.
HHI, exactly. And you really have to forget what you thought you knew about traditional, cyclical shipbuilding.
Right.
Our sources, and these are some intense financial and strategic reports dated just this week, January 11, 2026, they suggest HHI is rapidly ditching its legacy image.
They're pivoting. Pivoting hard. The sources are calling it a move toward becoming a high-margin defense and tech company.
I mean, that's a huge shift.
It is. And if you look past the sheer scale of the operation, what's truly fascinating is the transformation itself.
It seems so calculated.
It is. So our mission today is really to analyze the two massive shifts that are driving this. First, their new dominance in next-gen engine tech.
Okay.
And second, a huge structural expansion into the global defense maintenance, repair, and overhaul, or MRO market.
Right. So what does this all mean for the bottom line? For you listening, the core question we're tackling is this. How do these specific plays in tech and defense, how do they translate into this explosive increase in profitability? And why are analysts suddenly valuing HHI not like a manufacturer, but like a tech giant?
It's all in the margins.
Let's start with the cold, hard cash then, because this isn't just a theory. The numbers are already reflecting it in a pretty big way.
They really are.
The projected operating profit for 2026 is sitting at what, 3.36 trillion KRW?
Correct. And then it leaps up to an anticipated 4 trillion KRW by 2027.
These are just colossal numbers, especially for an industry that's often seen as, low return and brutally cyclical.
That's the thing. The scale is impressive, sure, but the jump isn't just about volume, which is what you'd see in a typical boom.
So it's not just more ships.
No. What we're seeing is a fundamental structural change in the quality of the profit. This whole escalation is driven by a massive boost in the operating profit margin.
The OP.
Right. The overall company OPM target is now sitting in the range of, get this, 16 to 17.5% by 2027.
16 to 17%. For anyone listening who tracks heavy industry, that is a huge leap.
It's massive.
I mean, standard manufacturing margins can often sit closer to, 5 to 8%?
If you're lucky.
HHI is effectively doubling the profitability expectations for their entire business.
That is the crucial observation. It feels less like a shipbuilder and more like, I don't know, a heavy equipment company that suddenly finds a patent on the highest demand part.
And what's the catalyst for that?
It's the engine business division. Our sources show the engine division is reporting an OPM that is heading toward 24%.
24%. That's a tech company margin, or like a specialty pharmaceutical margin. It's unheard of in shipbuilding.
Exactly. And this isn't based on some future hope. It's grounded in reality.
So it's happening now.
It is. This profitability spike is fueled by high-cost, high-value orders, specifically for those next-gen LNG and dual-fuel ships.
The ones secured during that high-demand, high-price phase of 2023 and 24.
That's it. Those ships are being built now, they're being delivered, and that revenue is flowing in with that incredible margin already baked in.
That makes the profit sustainable, at least for the near term, because the visibility is so high. The company currently has a 4-year backlog, estimated at around $45 billion.
A very robust backlog. And the breakdown is what's important. LNG and LPG vessels, along with defense and special ships, make up huge portions of that.
45% and 15%, respectively.
Right. So it's not just plain commodity tankers keeping the lights on anymore.
Yeah.
This stability provides the foundation for everything else.
Which brings us to that margin explosion and your first strategic pillar, engine dominance.
Exactly. The way they've secured this margin is through proprietary technology that basically solves the industry's biggest future challenge.
Which is emissions.
Right. The specific breakthrough is the world's first high-pressure, direct-injection ammonia dual-fuel engine, the DF engine.
Ammonia DF. We hear a lot about green fuels, but why is ammonia being described as the ultimate game changer? Why not methanol, for instance?
Well, the financial reports are calling it the final destination for future shipbuilding. And the reason is that ammonia contains no carbon. So once you have green production, it's a true low-carbon fuel alternative. This engine can run on traditional petroleum, but it can also run on low-carbon ammonia.
Which meets all those aggressive international maritime regulations.
It smashes them. And crucially, this is not just a prototype. HHI has already secured approvals from 7 global classification societies. The industry accepts this as ready for prime time.
Okay, so the tech is proven, it's green, but timing is everything. When does this actually translate into market volume?
The timeline is aggressive, but it's staggered. Commercialization started quietly in 2025 with a mid-sized vessel.
Right.
But the real proof point, the big one, is that the world's very first major vessel delivery with this engine is expected in early 2026.
And that's the signal the whole market is waiting for, the thing that accelerates acceptance.
Absolutely. The forecast in these reports suggests an explosive increase in DF vessel orders for 2027 and 2028.
Okay.
But here's the most staggering detail. Over 300 existing ammonia-ready vessels are currently waiting globally for an engine replacement.
300 vessels just waiting for these engines, that's huge.
It is.
That's like HHI is holding the master key to a multi-billion-dollar high-margin refurbishment market. It reminds you of, a company that holds the proprietary plug for a specific operating system.
That structural reality is key. This tech lead allows HHI's engine division to hit that 24% OPM, and that's before you even factor in the profit from building the ship itself.
So they get you on both ends.
It creates this powerful, vertically integrated structure where the engine business feeds this shipbuilding business.
Yeah.
It's a proprietary, high-margin component that competitors either have to buy from them
or try to match, which sounds nearly impossible.
Given the lead time and the approvals HHI has already secured, yes, it's very, very difficult.
So if the engine business is hitting 24% OPM, where does the second pillar, defense and MRO, stack up? That transitions us to the pivot into the maintenance market.
This is where HHI has made a brilliant strategic land grab. For years, HHI's domestic naval orders kept their dedicated defense docks at full capacity.
Right, so they couldn't chase other work.
Exactly. They were limited. They couldn't chase the lucrative defense export and MRO work globally. That capacity issue was immediately solved by the merger with Hyundai MRO.
When was that effective?
December 1st, 2025, so very recently.
And how did merging with a medium-sized shipbuilder solve a capacity problem for the heavy industries division? It seems a bit counterintuitive.
It's a really clever synergy.
Yeah.
They immediately converted 2 of the 4 existing MRO medium-sized docks into special ship and defense-only docks.
Ah, okay, so they're repurposing assets.
Precisely. This move is crucial because it resolves the capacity issue for their existing domestic naval orders, and at the same time, it secures an estimated 70 additional ships per year of new capacity by 2028.
70 additional ships.
And that capacity is dedicated solely to defense exports. Think major deals for frigates in markets like Poland and Romania, and that really high-margin MRO work.
70 additional ships a year dedicated to high-margin defense work. That's the volume you need to make this a real structural pillar.
It is.
So let's focus on the crown jewel here, which has to be the lucrative U.S. MRO market.
The scale is immense. The annual U.S. MRO market is approximately $14 billion.
Or 20 trillion KRW.
A huge number.
Yeah.
And to even play in that market, you need a critical credential, the MSRA, the Master Ship Repair Agreement license.
The official ticket to work on U.S. Navy vessels.
That's it. And HHI secured that ticket, the first Korean shipbuilder to do so. It proves they meet the U.S. Navy's stringent security and quality requirements.
And they've already proven they can execute. The sources confirm HHI successfully maintained U.S. Navy's 7th Fleet supply ships, like the Alan Shepard.
Right, so it's operational proof of concept, not just a piece of paper.
And their strategy here seems really interesting.
It contrasts sharply with competitors. Others have pursued these costly, really high-risk direct acquisitions of old U.S. shipyards.
Which is a huge financial drain.
A massive one. HHI is taking a much more practical approach, as the reports call it. It's an MSRA-based technical cooperation and equipment supply strategy.
So what does that mean in practice?
It means they minimize financial risk by not buying the yards, but they maximize their engine and component sales into that U.S. ecosystem. They sell the specialized equipment, provide the high-tech expertise.
Instead of taking on the legacy labor and compliance headaches of running an American yard.
Exactly. It's playing smart, not just playing big.
And the financial bonus here is the final draw. MRO, by its nature, generates margins that are about 2 times higher than new commercial ship construction. So if that MRO revenue stream comes through as projected, it could boost their overall OPM by another 1 to 2%, starting as early as 2026.
And that's how you get to that 17% overall target. The engine division pulls it up, and the MRO work solidifies it. It's an engine that produces high margins and a defense pivot that ensures those margins stay high, regardless of the commercial cycle.
But, no major market entry, especially into the U.S. defense space, is without its hurdles. And in the U.S. maritime world, the main regulatory obstacle is historic.
The Jones Act.
The Jones Act.
It's firm. It requires that U.S. coastal shipping must use vessels built in the U.S., owned by U.S. companies, and crewed by U.S. citizens.
And for decades, this has been an almost impenetrable barrier for any major foreign shipbuilder, including from Korea.
Absolutely.
So if the barrier is so firm, why are these financial sources dedicating so much analysis to signs of it softening? Is this just wishful thinking, or is there some genuine legislative movement?
There is genuine legislative debate, and we have to be impartial here and just report on the context the sources provide.
Well, of course.
The context is that domestic U.S. shipyards, especially those supporting the military strategic fleet, are severely capacity constrained. They're struggling to replace aging vessels.
So there's a national security driver here.
A huge one. And it has created a strategic opening. There is a legislative push, specifically the SHIP Act, that's the U.S. Shipbuilding Reconstruction Act, which is aiming for some regulatory easing for strategic purposes.
And what are they specifically discussing that could benefit a company like HHI?
The debate really focuses on two areas.
Oh.
First, allowing ships built by allied nations like Korea, a key U.S. security partner, to participate in the strategic fleet.
Okay.
And second, exploring opportunities for foreign shipbuilders to participate in the U.S. merchant vessel market through local joint ventures, or JVs.
So the Jones Act itself would remain firm for coastal trade.
That's the idea. But any progress on these fronts could crack open the U.S. strategic and commercial vessel market. The reports call it a potential tectonic shift.
The underlying factor being that the U.S. just needs a shipbuilding capacity of its allies.
That's what the debate is circling around.
It's definitely something to watch. The financial implications would be staggering if even a fraction of that market opened up. Which brings us to our final section, and the big question that always plagues a booming industry. Is the shipbuilding boom peaking out?
That concern is natural. You see these huge backlogs, and you assume new order volumes might start to stabilize.
Right.
But we have to differentiate between the peak of order volume and the peak of profit. And the consensus among the experts in these reports is that the profit peak, the OP peak, is still expected between 2027 and 2028.
So 2026 is still a period of strong growth, not decline, because the ships they're delivering now and for the next few years are those high-margin vessels that were signed during the best pricing environment.
Precisely. Peak revenue is still ahead of us, and a quick comparative analysis shows why HHI is so uniquely positioned here.
Compared to its rivals.
Yeah. Look at China's CSSC. They are strong in volume, sure, but they critically lack the advanced engine technology.
And they're shut out of the US MRO market.
Completely. Then if you look at their Korean counterpart, Samsung Heavy Industries.
What's the difference there?
The comparison highlights HHI's biggest competitive moat, engine internalization.
Meaning they own the tech for the most expensive, highest margin part of the ship?
Exactly. Samsung Heavy has its strengths, but they have to buy their core engine components externally. That immediately caps their OPM. They can't access that 24% margin HHI's engine division enjoys.
So HHI has the vertically integrated structure to maximize this supercycle, and their competitors just don't.
That's it. And this all brings us back to valuation. If they are structurally different, they should be valued differently.
Which is the strategic conclusion the analysts are reaching.
Right. HHI is being re-rated from a standard cyclical shipbuilding stock, which historically traded at a low price-to-earnings ratio, a PER of maybe 10 to 15.
And now?
Now it's being valued like a high-margin defense and tech company, a completely different asset class. They're targeting a PER multiple of 20 to 25.
That is a massive valuation jump. It fundamentally changes the entire investment profile. We're talking about the difference between valuing a factory and valuing the company that holds the patents for what that factory produces.
Well said. And the source material offers a final sharp takeaway on this. The reports argue the biggest bang for your buck, the place with the most profit elasticity, is the business entity itself.
HD Hyundai Heavy Industries, not the holding company.
Right, because of the direct impact of those engine sales and MRO revenues hitting the main operation.
So to wrap this all up then.
To synthesize everything, the story of HHI's re-rating is resting squarely on two undeniable pillars. First, that high-margin dominance secured by the world's first high-pressure ammonia engine. That fundamentally changed their profit structure.
Right.
And second, the immediate strategic pivot into the high-margin U.S. and global defense MRO market. That expands their capacity and revenue quality beyond the old commercial cycles.
It's a complete roadmap for industrial evolution. It moves them so far beyond their traditional identity. And when you look at HHI's even larger strategy, digital twin smart shipyards, investing in autonomous vessels like Avicus, you have to ask this final provocative question. Given the successful push into high-tech, high-margin engines and digital shipbuilding, how quickly will HHI complete its evolution from a heavy manufacturer to a purely maritime tech solutions provider?
And what new untapped global markets will that transformation unlock next?
Thank you for joining us for this deep dive. We'll see you next time.